For years, Canada was seen as one of the most attractive destinations for property investment. Low interest rate, rising property prices, and strong demand encouraged many NRIs to buy homes and invest in properties, believing that they would continue appreciating for years. But today that picture is beginning to change. Higher mortgage rate, rising ownership cost, and slower property market are forcing many investors to reassess their strategy. Well, for some landlords, rental income is no longer enough to comfortably cover higher loan repayment and increasing expenses. As a result, many investors are asking an important question tonight: is it still worth holding these properties or not? Is it time to move that capital elsewhere? Here, financial experts say that many NRIs are now exploring opportunities back in India. India's growing commercial centers, expanding infrastructure, and increasing demand for premium real estate have made the country an attractive option for investors looking for long-term growth. But experts also question against making emotional decisions. Moving money across countries involves tax planning, currency consideration, regulatory compliance, and careful financial planning. Simply selling one property and buying another without understanding these factors can create unnecessary complications for you. Whether somebody chooses to stay invested in Canada or diversify into India, the most important decision isn't about geography. It is about planning, because successful investing, it has never been about following the headlines. It is about understanding the numbers before making that particular move. For most people, falling property prices are bad news. When headlines talk about commercial real estate struggling, empty office buildings, and rising loan defaults, the natural reaction is simple: stay away from the market. But yes, that's not what some of the world's biggest investors are doing. Ladies and gentlemen, while many people are waiting on the sidelines, private investors, family offices, and large investment funds are quietly putting billions of dollars into commercial real estate. Reason? Very simple. They don't see a crisis. They see an opportunity. Across the United States, commercial property owners are under pressure. Huge loans taken during low interest rate era are now becoming due. But refinancing those loans have become much more expensive for them. At the very same time, office vacancies remain high in many major cities, and property value has dropped sharply. For some owners, holding on is becoming impossible. And when distressed properties begin entering the market, investors with available cash suddenly have the opportunity to buy valuable assets at prices that would have been unimaginable just a few years ago. And that's why experts say that market is witnessing a silent transfer of wealth. The people with liquidity are buying, while others, they are being forced to sell. But this isn't a market anyone should jump in blindly. Distressed properties often come with hidden challenges. Existing tenants may leave, building may require expensive repairs, loans may have complicated legal conditions attached to them. Buying at a lower price does not automatically mean that it is a good investment. For the NRIs, there is another layer to consider here. Investing across borders also means dealing with taxation, reporting requirement, and financial regulations in more than one country. A profitable investment on paper can quickly become complicated if those rules are ignored. Financial experts here say that opportunities like these reward preparation, not emotion. Understanding the number, evaluating the risk, and planning the tax implication are just as important as finding the right property. Message is clear. Every market downturn creates winners and losers. The difference here usually is not luck, it is preparation.